में।
Hello and welcome to India on the Move, the agenda for the 21st century. The emerging affluent. It's a class of people that a lot of experts in the financial services landscape do have their eye on. It's a class of perhaps savers and investors that can be a huge trigger for the economy. And we are here to discuss exactly that. How are the emerging affluent of India saving up for their tomorrow? Let me introduce my panel of experts. I have here with me today Nitin Singh, MD and Head of Wealth Management at Stancy. Nitin, great to have you on this panel. Anshu Kapoor, Head of Global Wealth Management at Edelweiss. Anshu, always good to have you here. And Nilesh Shah, MD of Kotak AMC. Nilesh, thank you so much for joining into this conversation today. So let me start with first the concept and the definition of the emerging affluent. When we're targeting this particular group of investors, or savers, or earning members, whom are we really talking about, Nitin? Is it an age profile? Is it an income profile?
So, well, actually, this profile spans across age profiles, because what we are really targeting is people who are really emerging in terms of their affluence, and therefore people who are, let's say, earning between anywhere from 0 to 2 lakh rupees per month, either across their household or personal savings, and essentially in a very pithy word to say, people who are generating enough income today that they can start saving and investing therefore. And which is really the focus in terms of the fact that this is a growing population within the country today, and really there are various means being looked at in terms of how do we really encourage these people to start saving and investing more.
So, Anshu, what's your sense? I'm guessing that this, loose set of people would also include more and more younger members of the workforce, people who just entered 25 to 35 and have high aspirations. How important would they be as a category of the emerging affluent?
Well, demographically, Surbhi, this is one of the biggest segments of our population, so their importance cannot be understated. And obviously, in the future, they will be the rising affluence and wealth creators of India. So definitely, a lot of heed needs to be given to their needs, what their aspirations are, what their wealth creation goals could be, and what is being offered today in the market space to serve those needs. I think there's a huge gap between what they need as savers and investors and what is available to them, even from a knowledge and awareness perspective. So there are a lot of things that we all need to work upon to bring to them tools or capabilities that will lead them to have this wealth creation on the long term.
Okay, we're going to talk about some of those aspects in just a moment. But Nilesh, your thoughts? I mean, given that the last 1 or 2 years have been so phenomenal in terms of getting in more retail participation into mutual funds, the fresh money that's coming in, are these new investors? Are these young investors? What's the sense?
So traditionally, wealth has remained more with elderly generation rather than the young generation. In some sense, young generation is EMI generation and old generation is SIP generation. But yes, compared to our lower base, over the last 2-3 years, we have seen more participation from new set of investors. We have seen more participation from T15 cities, the semi-urban and the rural areas. We have seen participation from young crowds who are digitally savvy. So compared to lower base, we have achieved a lot. Compared to potential, we have miles to go. Okay,
fair enough. The sense, Nitin, that you have on the millennials, the group that everybody seems to be targeting. As Nilesh said, on one hand, the propensity to spend has increased just because of aspirations, lifestyles. And then there is the compulsion to save. What trends do you see around you?
So, very interesting. Standard Chartered recently did actually a report on exactly this piece, which is the emerging affluent, where we focused on millennials as well. And a very interesting piece of data that actually came about was that 60% of this population is actually saving every month. And in fact, a more interesting trend was the fact that 17% of that is actually saving on a weekly basis. But I would say, contrary to popular belief, all of this money continues to go into traditional investments. So therefore, almost close to 75% is still being parked in savings bank accounts and time deposits, and you're seeing only about a 20-odd% trend moving towards mutual funds. And therefore, this is really where the issue is coming in, because if you really look at the various life goals that that people have painted for themselves, be it in terms of children's education, retirement, buying a house, etc., none of these would get met through just simple investments or simple parking into banking and, saving accounts. So really, as Anshu said, the piece is about how do we really encourage them to actually go and really start investing. And I think digital is where it plays a very, very, very key piece. Almost 43% of millennials are actually comfortable using digital bank accounts and actually using digital means to access their bank accounts. And in fact, one of the pieces that came out in the study is that the more people use this within the millennial category, the more they're comfortable saving as well. So you're actually seeing almost a multiple shift when people are using these channels because of their comfort in terms of using it today.
Okay, fair enough. Anshu, your sense in this, in terms of the client profile that typically your team deals with, what percentage would be the younger or the newer clients?
I think 50 to 60% are these young millennials, as you may call them, and working professionals. So there are a couple of big trends we are noticing. The biggest trend being the awareness to move from savings to investments. In a low interest rate environment, the awareness that savings or a bank deposit or a real estate investment may not be sufficient for them to get to their goals is a big one.
How is the industry addressing this, in terms of just providing clearer and better advisory, working with whether it's wealth management outfits, we hear of robo-advisory coming up these days. How can this be bridged?
So we need to see this in the historical and social context. Indians kept 12% of GDP in cash. Cash doesn't yield anything. It doesn't multiply, it doesn't grow, it doesn't give interest, it doesn't give dividend. Indians invested more in gold. Equity was delivering 15-20% compounded return. Equity mutual funds were delivering similar return, and yet people kept money in gold. So historically and socially, we are dealing with a class which doesn't understand financial thing. As Standard Chartered's report justifies or discovers that they considered savings bank account as an investment. So we are dealing with a class which has biases, which has prejudices, which has limited experience about financial investment. This is the class which might be wealthy, but they are not informed about financial markets. They need hand-holding.
And perhaps also confused because of the multiplicity of choices, the clutter and the noise in the market.
See, market doesn't give you clarity at any point of time, because if it's clear, it's already priced in. It's like jumping into the swimming pool. I mean, I can give you as much theoretical lesson as you want, but when you jump, you have to swim, and that's it. So you need a hand-holding, you need a coaching, and which is why if we start selling financial products directly to investors, it's going to lead into chaos. They will need a financial advisor who can hand-hold them, who can clear the clutter for them, and who can bring that discipline of taking decision. Most people are happy deferring decisions rather than taking decisions. I have seen so many salaried class professionals who are doing extremely well in their job, but their money remains in savings bank account because they are all waiting for that elusive correction. For 20 years that correction has not come, but they are still waiting for that correction to come. We are a great nation of saver, but we are a pretty useless set of investors.
That brings me to the first break on this discussion, and we carry this very interesting point forward. How do we move from being great savers to great investors? Back in a moment after the break. Welcome back. Here with India on the Move, and we are discussing how the emerging affluent can save better for tomorrow. And the big question is, how do we as a nation move from being a nation of savers to a nation of smart investors? Anshu, I'll start with you. That's a tough question. Let's get your opening thoughts.
Well, in our opinion, I think the first step is creating awareness that it is simple, it is long-term wealth creator, making it simple to access, making it simple to execute. Creating that knowledge base and awareness, that is number one. Second is very important, is to establish trust. We believe there is a lot of gap in the image of the financial service provider, what is perceived by the end consumer. And we believe that needs to be bridged significantly before this huge adoption happens in the industry on investment solutions or products. And finally, it's about keeping it simple, declutter, demystify, make it very, very simple. And also, like globally that's happened, you know, directed savings into investments, for example, pension funds and other vehicles. If those can be set up and maybe some kind of fiscal policies created around that, that will direct some flow into simple investment products, that will make a huge difference.
Okay, Nitin, your thoughts on this, and particularly the regulatory environment that we are in, because it's always a question of whose interest. I mean, the advisor has his interest in mind as well, then there is the client and there is the manufacturer. How do you see these trends evolving?
So I think, you know, if I just pick up on what Anshu is saying, and if we actually put these three segments aside, I think the biggest hindrance that we have today to actually encouraging mutual fund use is the fact that we need a common KYC. And therefore today for a customer to actually want to invest within a mutual fund, there is an additional leg that he needs to do, which actually automatically is a huge hindrance. And you know, this is something that has been raised time and time again by the entire community, be it distributors or be it manufacturers with SEBI, in terms of talking about the fact that we need to allow customers who have a bank account already to be able to invest into mutual funds without any further KYC. I think.
But why is it such a huge hindrance? Because one would imagine with the promise of, you know, a single click KYC, things would get more streamlined. Isn't that becoming the case? So
yes, so that is supposed to be the ultimate goal. But today clearly you have something called CKYC, which is what is happening in banks today, and which is of course taking its own form and route over a period of time. And then you have your CVL KRA happening for mutual funds and capital markets, and therefore there is a little bit of a break within this. I think really what Anshu was saying, and if I actually add on to it, if you make the process seamless, I think that is a huge piece that the regulator can do in terms of really encouraging the use of this medium.
The term SIP, I think, has become far more common. It's in knowledge now across households in the country. But when you're looking at first-time investors and you interact with so many of them across the length and breadth of India, where is the hesitation in making that changeover, moving from that fixed deposit, getting into mutual funds? Has that diminished over the years?
So in 1997, when I started my career in mutual fund, people were asking, what is mutual fund? Today, there is a significant movement. Today, in most parts of India, we are being recognized, we are being asked relevant questions. So, we have covered a lot of ground. But couple of things which we can copy from other financial intermediation sectors. In terms of banking, if we see, I mean, there is an implicit faith of government behind every bank. Today, despite banks declaring huge losses, no one runs to withdraw their money because there is implicit backing of government of India. In mutual fund, there is explicit risk factor. Mutual fund investments are subject to market risk. So if we can convert this explicit risk factors to, in a positive manner, saying that not doing your financial planning is risk to your financial security, I think a lot of connotations will change. The second thing which we have seen is the new pension scheme. I mean, it has collected lots of money from government employees because it's compulsory allocation. It gets deducted from your salary every year. In Provident Fund organization, we have seen the same thing. In mutual fund, it is completely voluntary. Now, can I create an allocation backed by some tax advantage in the initial period so that people get experience by default and then it becomes the habit? The third thing which we have seen on the insurance side, I mean, their agency network has reached nook and corner. There are probably 2 million plus insurance agents. In mutual funds, there are 80,000 ARN holders, and maybe if you count number of employees in those ARNs, it's about 200,000. You can't expect mutual funds to grow with 200,000 feet on street. I need to make it 20 lakh, just like insurance industry. So how do I do that? I have to copy what insurance industry has done and refine it to make this 20 lakh people. So one, I need to keep customer in mind always, there's no doubt about it. But I need to give him some statutory incentive so that he gets pulled in. I need to have feet on street so that he is hand-holded all the time. And what SEBI has done in terms of regulatory framework, obviously that is creating confidence in mutual fund industry. Put all these things together, I think mutual funds will become part and parcel of every man's life.
Okay, points absolutely well taken, specifically on tax. I mean, if we were to ever move beyond that 1.5 lakh limit of ATC, I think it would go a long way for investors. But let's talk about what we have to work with, the framework right now. I mean, there's an ideal scenario and there's a present scenario, and what can be done here. So, Anshu, looking at the here and now, what is it that you're advising your investors? I mean, we're saying saving for tomorrow. So, I know risk profiles will always be the first sort of, barometer. But generally speaking, equity the way to go, fixed income, because we keep hearing a lot of questions on fixed income as well. People understand that at 6.5% plus inflation, you practically get nothing from your fixed deposit.
Absolutely, you're absolutely right. So the real interest rates in this country are obviously headed down, and we believe that we are structurally moving to a lower interest rate environment. So what does the saver or the investor do? I think number one is to make people aware the need for financial planning and asset allocation. Just to these simple terms, to drill them down in their financial psyche and to spend time with them to make them aware as to how, in a simple manner, without taking undue risk, you can be better off in the future. I think awareness, as I said earlier also, is a big driver. The second is to give them simple tools. Listen, here's do it yourself. You can go online, you can be on the mobile, but just try it out yourself. Play with a calculator, see how much money you need and where are you today. So, and when people see the enormity that, listen, I need to save 20 years down the line so much money, and at this 3% real rate of interest, this is where I'll get to. I think it maybe makes them a little bit more concerned about the need for investing. So that's the other one. And what we believe is this, like you pointed out, Nilesh pointed out, mutual funds have become very acceptable now. Mutual funds, retail participation in mutual funds in this country is about 10% of the GDP. Compare that to about 50% globally. I think give them simple solutions, let them get invested and move them over a period of time. So that is where you can move the needle over a long term. But yes, definitely exposure to equities is a must if you need to move the needle on your wealth creation.
Nitin, the question also is for savers / investors, how to sort of approach the equity market. There is a direct equity route, there is a mutual fund route, and there is still the insurance route, because let's not forget that big market, and there are still products which are tying, two objectives. Though I keep hearing advisors saying you should always segregate them. But your thoughts?
No, I think especially for this class of customers, the most important piece is in terms of financial goal setting, because they need to have a goal towards which they're aiming. It can be quite ephemeral, saying put away 20,000 rupees or 30,000 rupees every month, but really, what is the goal that they are aiming towards? I mean, so I think that is the most important piece that we need to try and drill down more. And similar to what Anshu was saying, we need to provide those tools and we need to provide those platforms where people are able to set those financial goals in peace. I think the second piece really comes in terms of the most favorite word today, in terms of SIP and equity. It is important for customers to have some allocation to equity, dependent on their risk profile, of course. But I think that's a very important factor in terms of what they are doing. And I think really the whole habit of systematically investing, be it either in equity or fixed income, and really stopping to worry about when they're going to get the next dip within the market, and really being very disciplined about their goals is something that we can really try and aid investors towards. Because if we can try and make that shift happen, then really most of our work is done.
Sure. But speaking about waiting for the next dip, but Nilesh, to be fair, I guess this time around at least people aren't getting jittery and they're not looking at selling at the top, or is that still a phenomena?
You haven't met people in Kolkata who all sold in November and December and are waiting for correction. So it's in a lighter vein, not that every Kolkatan has done this, but when I went to Kolkata this time, I met many people who sold out in November and December because of demonetization related anxiety and now waiting for correction. I mean, if I can take forward from Nitin in a lighter vein, people need to read Ramayana and Mahabharata for equity investment. So one way to do equity investment is like Kumbhkarna. He invested in equity markets, went to sleep for 14 years. Yeah. After 14 years, he woke up and he was very wealthy. So follow Kumbhkarna. The second thing is Eklavya. I mean, Eklavya had dedication to learn. He just needed an idol of Guru Drona and he became the best archer in the world. So please develop Eklavya's dedication if you want to go direct, and you can keep one of the fund managers idle. They have done extremely well. The third thing is follow the Pandavas. In the epic battle of Mahabharata, Kauravas had more resources and yet they lost out because they chose a wrong advisor, Sakuni. The Pandavas had lower resources, but they chose the right advisor, Krishna, and they won the battle. So get a good advisor. So apart from what Nitin mentioned in terms of asset allocation, regular investment, long-term investment, systematic investment, please keep in mind Kumbhakarna style of investment, which made Lankans very rich. Please follow Eklavya if you want to go direct. And please think about Pandavas, how they choose their advisor to win the battle against worthy enemies.
So I'm going to end on that last note. Since choosing the right advisor, getting the right advisor is basically the key to everything, the key to making money. Let's get the three of you to offer that one last tip or one last piece of advice for the emerging affluent. If you were to sort of give out some sort of advice or hints, Anshu, what would they be?
The only advice I could give, and following the analogy that Nilesh gave, was it's not about timing, but it's about the time that you spend in the markets. That will make all the difference.
Okay, and Nitin?
It's all about discipline and actually aiming towards that end goal.
Okay, Nilesh?
So one, you were the retirement solution for your parents' generation, but don't try to do that with your kids. I really pray kids will take care of you, but you could be surprised. So have your financial independence, plan for that, and just be disciplined. It will create wonders. Compounding is the 8th wonder of the world as per Albert Einstein. Let it play for you.
Fantastic, gentlemen. Thank you so much for the thoughts and the insights. Well, that's it then on this conversation on India on the Move.